Hello, hello, hello. How's everyone doing? It has been a minute since we've last spoken. A lot of changes are happening for the better. I hope 4th of July treated you well, and I hope that you guys enjoyed that video. I was just trying to practice my editing skills. Definitely a lot better than how I started. Uh, I used to do some DJing back when I was running an Arabic cafe, so I had some experience with that when I was in high school. So I did some of that. I went to high school, and at nighttime, I've always working from day one, right? So, um, in this video, I got a lot to talk about, right? In terms of Clover, I have a video that's been on the under the radar, and I actually want to give a shout out to one of our members on our Al Stock Alerts platform. I'm not too sure if he's mastering or Al Stock Alerts. I think it's Al Stock Alerts, and I'm very excited. Our private Discord group has become very just they're finding things that are pretty impressive. So one of our group members was able to find this video that has just 43 views, just 43 freaking views, and I was looking at it, and I saw something deeply important. These individuals, and I thought I recognized them. They were the same people that helped with a former startup called Epic, which you may have heard if you're in the healthcare systems. Epic is a internal system, charting system that hospital systems use. In fact, my hospital here in Tucson, Arizona used to use it, but they then transitioned to Cerner as they were bought out by Banner. And recently, Cerner was just bought out by Oracle, right? So I'm going to give you guys my interpretation, kind of my experience of what these systems are. Personally, there's like a battle that I've seen in healthcare. There's some people that really like Epic, and there's some people that really like Cerner. I'm just, for me, I'm like, I'm just trying to master the one so I can, give the best care to, future patients. So, but Mayo Clinic, which I was recently at, they use Epic, and it's funny because the same system that Clover is using were the same people that helped scale Epic to being one of the world's best healthcare charting platforms. And I kind of got the vibe of that's kind of what Clover was after. So they're not just an insurance company, right? There's something else. So I mean, grab a beverage, enjoy, relax. You know what I mean? So I got some hot coffee. I hope you guys are doing good. Definitely, let's go. Vibes. Definitely, Clover's been doing well. So in this video, we're gonna go in and go after this video I'm about to show you at 1.5 times the speed. So you may have to slow it down, which is simple. You just go to the settings icon on YouTube. And after that, we're going to do some technical analysis using our artificial intelligence platform to look at what the hell has been going on with Clover. Now, just recently kind of going over some important aspects, let me go ahead and share the screen here so we can go over some important things here. So as you can see, this is the video we're going to be discussing. Something that we really want to talk about. But I also want to go to our private Discord. I guess we'll switch device. I don't know what that did, but so what I want us to do is I want to take us to our economic calendar. All right. And what we're starting to see here, this is our July economic calendar. All right. I want you to write down 2 dates. Obviously, there's a lot of important dates here, but the 2 main ones, you could add this one to retail, but the 2 main ones is Wednesday, July 13th. This is the June's CPI report. Okay, that's important, right? That's going to see, has inflation peaked? I personally think it hasn't. I think it's going to be very bad. But the biggest one is going to be July 28 Thursday. Now, why? Well, look at the first thing here is GDP Q2. Have you ever, the official second quarter of the GDP is going to be announced. And I think this is when we are officially going to see headlines, they're going to say we are in a recession. Now, if we don't, that's going to be quite interesting. I personally, it's very hard to see a recession when you have a tight labor market, but the labor market is a lagging indicator. So it'll definitely come into fruition. So let's see here. Yeah, you see, I have to say, I've seen a lot more people like Epic than Cerner. I'm new to the healthcare arena, so I'm just trying to get one down. You know what I mean? So, all right, have you seen Ortex at 56 million short and cost to borrow rising? Talk about and what the short. Is. So in our brain machine, we are going to input short interest data directly from Fintel, which is cool. We're going to be incorporating that in there. So it's going to be included in the membership. But what we do also, since you've mentioned it, might as well just quickly kind of side deviate right now and take a look at the short here. If someone has looked into it, this is part of our Discord here. Let's see if anyone's looked into the short here. So we can go to options. Yeah, let's go. Let's do that. Let's take a look at that. In learn, oops, trade master, and let's do short. Any top short volume. Let's see. So let's do that and let's go through options. Type in Clove. Oh, this just gives you the top. My apologies. We have it here. I forget the command. It gives you the short, the actual short of the specific stock. Personally, I've been out of the market recently. I've been focusing on. I'm still dollar cost averaging, but I've been focusing on building the website and doing the lecture notes. So it's been quite of a struggle for me. But here it is. There it is. So short volume. So it's been quite of a struggle for me right now. All right. So let's look at Clover since you've mentioned it here. So we did see a peak in June in terms of the total volume here, and the short volume is in red. So we are starting to see a creep up in the short volume. Literally, that's a pretty decent size jump. Now, personally, I'm more of a fundamental investor. So, I feel like following the actual fundamentals of the business is actually a little bit more worthwhile. You don't want to have a short squeeze stock and that's it. I mean, it's nice if it comes in both the fundamentals and the short. The beautiful part is once the stock does rise, many uneducated people are going to think it's a short squeeze when in reality, it's actually the stock ascending to its intrinsic value. So that'll be great because then it'll give us value investors an opportunity once it becomes free cash flow positive to get the hell out of there as retail takes it to the moon, which I'm not writing. I'm going to get out at a certain price target based on very design metric criterias. And I won't bat an eye if I miss out on a $500,000, $1 million, $2 million. I won't even bat an eye. Okay, so let's go ahead and go back to this economic calendar because it's very important. Okay, so July 28th, write that down. That's going to be that GDP growth. Okay, we're going to see if we're going to be down. Now, personally, the Atlanta Fed just recently talked about how we are going to it's negative, right? Let's look up sector rotation. Let's look up the fear of greed index. This is directly from our mastering course. And let's go ahead and go to, let's control find GDP. Let's look at up the GDP here. So as that loads, So that's not loading up here. Let's go ahead and focus in on this GDP here. So as you can see here, guys, we are getting a negative read on the GDP, especially if you zoom out down here. This is indicating that we are headed into a recession. In fact, we are probably already in one. Okay. Now, if you go ahead and take a look at the personal savings rate, which usually, is a good indicator there to kind of show you how depressed we are. When they were printing a lot of money, people had so much that they invested within the markets, but now the money's being sucked away. And you can see that we're at lows that we haven't quite seen since the 2008 financial crisis. Not saying that we're going to enter one. It's just keep this in mind, okay? In terms of the fear and greed index, we are getting to a point where it's becoming very greedy. We are getting a buy here, a buy, and a buy. So people are starting to buy. We are returning back to the mean. We could be anywhere between the capitulation to despair. So we don't really quite know this. A lot of people we're probably headed up here, returning to the mean. And a lot of people are probably saying, oh, Clover's going to drop. Oh, Clover's going to drop. Now it might. But there's some people that are thinking Clover is going to drop to $1 or 50 cents. And I just, just look at Voyager. Voyager is bankrupt and it's at 20-30 cents. Why would Clover do that, right? So people sometimes, retail tends to take it to extremes, right? So there's that. So I wanted to just kind of give you a brief overview about what's going on with the market. The Federal Reserve, what's happening right now with the Federal Reserve is that they're stuck between a rock and a hard place. The U.S. government is in so much debt that they can't raise interest rates super high because the U.S. would, can't afford that, right? So today, one of the Fed personnel specifically stated that once inflation does start dropping, they're going to be okay with cutting rates, which again, once you cut rates, interest rates go down, people are most likely going to spend, and it resynchronizes the next bull run. Okay. So there's something that you guys need to kind of pay attention to. I'm just mentioning things that are important that people haven't, because it's been a while since we've talked, so I want to make sure I get you guys up to speed here. Comment down below if there's anything that I missed that happened in the market since I've been gone. Yeah, I think that's it. All right. So now that we went that, kind of gave a little quick market analysis and update, we're going to go in, and if my microphone switches, apologies, I'm going to go ahead and put my headphones on and then fix the microphone here. Okay. Hello, hello, hello. Testing, testing. Okay. All right, good. So now we're going to go in and we're going to watch this important video. Okay. So comment down below. Tell me what you think. This is very informative. We're going to raise the volume so you guys hear it, and we're going to get straight to work. Let me go ahead and like it for them. And please don't forget to like this video too. You know what I mean? It's like Inception, liking a liking video. All right. So take us to Valhalla. How good is it being added? Oh, it's very. I think it's good, and they're going to continue getting added to better, to the higher indexes too. You were right all along, bro. Yeah, no, I did. We did short. The data suggests short bear market, and then we could default back down, but definitely our calculations are pretty on point. Now we'll see if the fundamentals keep up, which at this end of this video, if you stick around, I'm going to be showing you the cash flow that from Clover quarterly, and we're going to go in and go to the technical analysis, and I'll show you some hidden gems in there. Clover is growing. I think it's important to look at the open position at Clover currently. There's a lot of enrollments in terms of open position, do you mean like interest, short interest? Because I don't really analyze those, to be quite honest. How do you feel about the average projected 5-year growth at 19%? I would say that's pretty reasonable. I would say for a growth company in the beginning, I would say 30%. But sometimes I do 10 to 15. I'm very conservative, you know. I appreciate these updates, lives, and superb content. I appreciate that. I appreciate that, Habibi. Thank you so much. Thank you so much. So I'm going to go ahead and I'm going to pause it right here, and then we'll get to this video right now. So let's do it. Please let me know if you hear. If you can't hear, holler at me. So I'm getting no sound here. I'm getting no sound. Can hear. Let's start over again. Interesting. Yes. So StreamYards is stupid. There's a special way to do it. So there's a special audio way to do it rather than just share a screen. My apologies. Let's do it now.
So for this next bit, what I'm going to talk to you about is pulling out all the stops in healthcare. And I would say,
can you hear now? Holler at me.
Say that we're at a very disruptive time in our industry. And I would say a good disruption, actually. There's a lot of excitement. There's a lot of new investment. There's a lot of change and those sorts of things.
Thank you, guys.
Driven by a couple reasons. One is we've digitized healthcare, basically. And so it's a little bit like perhaps moving an economy from like a steam-powered economy to electricity. You suddenly have this new platform, new technology, opens up new companies, new approaches, new ways to do things. And that's where we are with healthcare. And I also think the pandemic has encouraged us to kind of get off the couch as an industry and build hospitals in 2 weeks and redo the workflow in our existing organizations to build vaccines faster than we've ever done in history.
So this is very important. I want to just really pause it right now and just kind of focus on this. A lot of innovation has happened within industry, and usually healthcare tends to lag. It's always kind of an approach. Like I was working with a paper that looks at robotic neurosurgery, and what we found is that industry has always led in that. I mean, the first was, Henry Ford assembly, and then you have now Tesla doing their whole robotics and assembling the whole car. Now we're starting to get robotic neurosurgery, robotic spinal surgery, and we're slowly getting into this field, like the Da Vinci systems and whatnot that they have in healthcare. Healthcare tends to lag, and now finally we're starting to see that transition on over to the healthcare system. So we're at the bottom end of that, just like how kind of the car realm was kind of old. Now we're transitioning out of that. We're starting to transition into a new world order. No, I'm just kidding. Right, a new type of economy in healthcare where we're using tech to solve problems.
To take care of patients via video, those kinds of things, those kind of quick changes.
Telemedicine,
I think, encourage a spirit of disruption and change in our industry. But before I get too far on this concept, does anybody know where the expression "pull out all the stops" comes from? One person. A few? Very good. Very good. I did not know, actually. Apparently comes from, I know now, it comes from church pipe organs. So a church pipe organ basically the keyboards have like 61 keys. You maybe have 2 of those things, but they're way more than 61 pipes. You might have 1,000 different pipes, the big ones that you see. Sometimes there's a pipe room with a whole mess of other pipes as well. And what happens is that there are these stops. So let's say the flute stop. When you pull out the flute stop, that lets the air through the pipes that sound like a flute, basically. So as you play the keyboard, it'll sound flute-like. And if you want the organ to sound like a trumpet, then you pull out the trumpet stop, and those pipes will be activated. And if you want to sound like both, you can pull them both out, and it'll sound like a flute and a trumpet are playing together. Or you can pull out all the stops, basically. And what happens when you do this is all the pipes are activated, all the air is flowing through all the pipes, and you have this giant orchestral kind of all-in sound for the organ. And I think this is a good analogy for healthcare. There's really an all-in approach. There's a lot of companies, a lot of investors, a lot of excitement, in our industry, and it just feels like all the stops are out. And I would say there's kind of three major forces that are driving change in our industry: economic, consumerism, and technology. From a economic point of view, you have a lot of investment in healthcare. I read recently that there's 5 times the amount of investment in healthcare than any other industry. And healthcare is not 5 times bigger than other industries. So there's kind of this giant interest in getting into healthcare. And you can even see with big companies like Oracle buying Cerner or Microsoft buying Nuance or those.
See, he just mentioned it. Oracle buying Cerner. Again, Cerner's like Epic, right? There's a lot of investments and interest within healthcare because it has been lagging in terms of sector rotation for quite the longest time. And usually in eras of recession or in eras where the stock market's going to not perform, there's a lot of speculation that suggests that the U.S. stock market has been overperforming the world economy, but has not been contributing to the global GDP, which indicates that perhaps maybe NEO, maybe Alibaba, Tencent, and a lot of these Chinese stocks and a lot of international companies may actually start leading in outperforming U.S. stocks, right? So a lot of hedge funds are now trying to turn into other investments that have not appreciated that much in value. If you compare the healthcare in comparison to the sector, to other sectors, healthcare has been lagging. Now, usually in times of recession, in times of frugality, healthcare tends to outperform because people don't cancel their healthcare. It's quite simple, right? So that's something very important to just go into in terms of the 5 times investment. Likewise, we have a baby booming age, the baby boomers that are turning 65 years of age. There's so much, and all of that is going to overburden the healthcare system. Likewise, we've realized that our hospital systems and healthcare systems are not the best. A pandemic crippled everything. We had to have refrigerators for dead bodies outside of hospitals. That was how we failed as a healthcare system. And now everyone sees this problem and they're trying to solve whatever healthcare problem that exists. So there's a lot of opportunity in this, okay?
Those sorts of transactions. People really want a piece of healthcare and they want to be engaged in this great industry. But on the buying side, so the governments, payers, purchasers, times are still difficult from an economic point of view. So we have an aging population. Our boomers are getting into those ages where they have multiple chronic conditions and those sorts of things. The cost to take care of a patient rises per year faster than most of the rest of the economy. So we have to choose between other social programs and healthcare and other things we want in our economies typically.
So, and it's obvious, right? So as you get older, the cost of making sure you're okay, you have the same quality of life or sustained quality of life, it's goes up. It becomes extremely more expensive. So all that, unfortunately, is the healthcare system able to handle that? And on top of that, how is it able to handle it when you have a depreciating, dissociated middle class, when you have an ever so increasing gap between the haves and have-nots of society? How do you essentially how are, like, for example, if you're Hispanic, Black, Native American, how are you able to perform in terms of your life expectancy, especially nowadays when inflation is at its all-time highs, things are becoming more expensive. The cost of education is at its highest. We already know that education increases your life expectancy. So people that have college degrees tend to live longer. They get paid more longer. We know that people that make more money live longer. So we know that healthcare also, we have some disparities upon that. And is the healthcare system, can it handle this? So what can we do? We have to turn to technology.
There's very thin margins. Health systems have already been thin. They've run at a 2% margin or so, but all that had been wiped away with the pandemic. So it's a very stressful time financially on the health system side. And buyers are, not as interested in paying fee for service, more. Basically, they want looking at different payment models, like accountable care, paying for a set amount per patient per year, or global budgets for a public health system, a set of hospitals. Here's your budgets for the year. Good luck, take care of your patients, that kind of thing. So there's a lot of economic stress in the market that's creating churn and change. One of the most exciting areas is the rise of consumerism. And actually, this is the area that we've had most of the interesting discussions with all of you, our customers, around the last 6 to 12 months. So us as consumers, our expectations are changing. And they changed pretty rapidly during the pandemic. We want kind of that anytime, anywhere service, just like we get in other industries, banking or retail or finance or anything like that. We want that out of healthcare too. And you have companies really innovating in this regard. So you can get your physical and vaccination and flu shots and all that stuff at your local CVS or Walmart or things like that. You can get your pharmacies refilled from Amazon Pharmacy, or CVS and Walgreens are working on things like that. So healthcare is kind of coming to you as a consumer. And so we've had a lot of very interesting discussions, like I said, with many of you. We'll hear from Eduardo from Recession in a little bit, talking about some of his changes he's driving in this regard. But I'll give you a couple examples. So we were talking to this big health system about their patient portal. And a lot of health systems are building what's referred to as a digital front door. So they spend kind of millions on the physical front door to sort of reflect the grandness of their brand. But the digital front door should look just as exciting and just as reflective of the way they want they want to reach out in the community. But for this particular,
and he's about, so just in connection, this guy said he is talking like they are leaders in the boomers. Well, if you stick around in the next 6 minutes of this video, he is going to be talking about Clover Health. So definitely pay attention.
This particular customer actually has
and learn.
Many health systems. You can't use the patient portal unless you're a patient. So you have to first become a patient, a registered patient. You almost have to get sick, in a sense, before you can actually interact with the health system. So though they had a digital front door, it's closed, basically, unless you're already a customer. Now, what kind of business does that? What business would have the doors sort of inaccessible until you're already a customer? Most businesses want to reach out to their communities and engage new people. So converting that digital front door to something that is more consumer-focused, not just patient-focused, that's reaching out to the broader community before they actually need the services of being sick. Another example is this concept.
AKA, it's called preventative healthcare. The problem is, think of like airplanes, right? Airplanes are flying above us. The only time the healthcare system intervenes is when you're about to crash. And unfortunately, they get at you when it's a little too late, when you've descended into a terrain where it's so difficult to raise you back up, right? So that's the problem with healthcare. It's sick care, not healthcare. And Andrew Toy does a great job discussing this in a lot of his LinkedIn posts as well, which we will now get sent directly to our Discord from just easy programming. So it's unfortunate that we have this, but a lot of incentives and preventative healthcare measurements are being taken even at the medical school level, where the training and the next generation of healthcare providers is happening as we speak now.
Concept of rest of year. So we all go in to see the doctor 3 times a year. What about the other 362 days? What's the kind of interaction that you, if you're a health system or a payer or life sciences company, want to have with your community when they're not in the building? What's the kind of engagement that you want to project out there, and relationships you want to have with your community? So a lot of kind of more consumer-oriented thinking is getting into our industry. And I'll give you one other example. So I have a shoulder that dislocates. So it's come out 9 times. Does anybody want to see it? Come on. I'll leave it in. And I had a couple surgeries to try and fix this thing up. And after one of the surgeries, I remember distinctly going back to the hospital and asking for my medical record. And they said, sure, we'll provide it to you. It's $10, and we'll mail it to you. And they mailed it to me, and I got it a couple weeks later. Now, that's kind of a very normal activity. Everyone's probably nodding. No, I've done that too. Can you imagine if your bank did that? Like if you went in and asked for your bank account balance, and they said, sure, we can provide you that. It'll be $10, and we'll mail it to you, and you'll get it in 2 weeks. That would be ridiculous. But that's a bit of the ridiculousness that healthcare has had over the years with regard to kind of consumer friendliness. Now, that particular problem has changed a lot in the last 2 years. If you have Epic, if you go see a health system that has Epic or
Cerner
or TrackCare or those kind of products, if you have an iPhone, you can get access to your medical record at lunch. Basically, you can get the whole thing. They're not that high percent of the population actually knows how to do that and that sort of thing. But things have opened up rapidly the last couple years. So the third area of change is technology. So this year, for instance, we will buy 320 million wearables. So this is a kind of a suddenly big industry for all of us. And not just Fitbits, but medical devices in the home, blood glucose monitors, ECGs, those kinds of things to sort of monitor patients in that setting, so you can get care where you want to get it. And then a lot of experimentation around chatbots, artificial intelligence, virtual reality, different kind of approaches to take care of a patient where they are instead of everything being about a physical visit between you and a doctor. So a lot of exciting change on the technology front as well. And I think all of this is supporting a transformation in healthcare, a digital transformation in healthcare, moving to kind of a new healthcare environment. And I would just say 3 characteristics about the new healthcare environment. One is that it will be digital, so the kind of experience that we're used to in other industries, we'll have that in healthcare as well. Second, it'll be more flexible, so it'll be on our terms as consumers, not just necessarily on everybody else's terms, so that anytime, anywhere, kind of flexible approach to healthcare as much as can be done will be part of the more part of the future. And the third is, I would say, omni-channel. So from a, let's say, health system point of view, or a payer or life sciences company conducting trials, that kind of thing, you would think about more than just the in-person experience. So what does that experience look like? Well, what does our portal look like? What do the kiosks look like? What does our social media presence look like in the way we interact with our consumers that way? What is our community events, sponsoring races, our advertising? What does the whole approach look like between us and our community, not just focused on that the visit concept? So we're mid-transformation, and that's quite exciting. Now, in a disruptive environment where there's a lot of change, one of the most important things that you need to do is decide on your role. So what kind of role, what kind of unique angle, what kind of unique value proposition are you going to offer out in your communities, in your businesses? Are you going to double down on the status quo, let's say, and say this is, we've always been best at this and we'll remain best at this while everybody else sort of flounders with new approaches? Or are you going to pick some of these new approaches, double down on those and see if they work? So there's a lot of choices to be made in a highly changing, dynamic environment. And we've made choices as well. Areas that we think we should be great at and invest in those.
And they're extremely good at scalability, this intersystems, and we'll go into them very shortly.
Areas. And I'll talk through these 5. Interoperability, enabling innovation, scalability, clean data, and insight. So for interoperability, starting there, you can imagine now interoperability becomes even more important. If you have kind of this more decentralized healthcare system, more flexible healthcare system, more people involved in the health of the general population.
Let me know if you guys hear. They're about to talk about Clover very soon.
Free flow of information among all the parties is absolutely essential. Otherwise, it actually has the danger of being even more fragmented of a healthcare system. So interoperability is an area that we choose to be great at. I'll just tell you about one project we started earlier in the year. We launched a new offering called Health Connect Cloud. And this is basically a software as a service with our interoperability engine, Health Connect. It's paid for on a consumption model. It's easy to sort of start up and digest. Our very first customer is the Northwest London part of the NHS in England. Basically, they had 4 different hospital trusts. Each had their own integration engine, different engines. Each had their own team, sometimes building the same integration to the same third party. And they brought all that together at the regional level, picked our technology, standardized on our technology, and now they have a shared team for the region. So they can build integrations once. They can kind of manage the workload of the trusts instead of at an individual level, and manage the 24/7 operations. So that's we've actually signed a couple more customers with Health Connect Cloud. It's a great interest to many customers. The next area is enabling innovation. Of course, in a time of change, you need to move quickly. Some things are going to work out, some things are not going to work out, and you want to navigate that very quickly. So supporting you and your need to be agile is another area that we choose to be great at. Now, InterSystems has always been a buy and build company, or enabling you to buy and build. So we have certain applications like TrackCare or HealthShare, where you can take advantage of kind of a full stack type of application. But we also have the world's best development platform as well. So you can take what you can get from us, and then you can kind of build innovation around that to have a unique perspective in your market. So example project of that is one we're working with starting earlier this year, Clover Health. They're a new payer customer of ours.
So there it is. So what I'm going to do is I'm going to go ahead and put this at 1 times the speed so we can kind of see what's going on here. And definitely pay attention, right? We wanted to kind of build it up now, and we're going to go ahead and debrief and go from there.
But we also have the world's best development platform as well. So you can take what you can get from us, and then you can kind of build innovation around that to have a unique perspective in your market. So example project of that is one we're working with starting earlier this year, Clover Health. They're a new...
So they're going to be working early. Let's go ahead and repeat that. My apologies. That's very important.
Good. So example project of that is one we're working with starting earlier this year, Clover Health. They're a new payer customer of ours, and their goal is to distinguish themselves in the market via technology. So they use artificial intelligence, sophisticated algorithms to help the decision-making of their clinicians, their case managers, their authorization folks, claims folks, that kind that kind of thing. And they sort of pack all this into an app called the Clover Assistant app, which they use to empower their users.
Now let's pause for a sec. Now, when you look at the first stages that they choose to be good at, he being this person, they specifically stated that they created a software as a service, a SaaS company, in which a European hospital-based systems is basically using it. So these individuals are extremely good at curating a product that is, first off, as a SaaS, number one. They have the brand recognition too. And don't let the subscriber count of this business and the limited views of 2.59K subscribers deter you away from what this business has done. They helped lead the greatest change in Epic systems and made it so global, which he'll discuss right now. This company knows exactly what they're doing. Okay.
With these algorithms, they needed us basically. They needed clean data essentially. So they wanted to bring all their data together, clean it up, aggregate it, normalize it, deduplicate it, and then build applications on top of that. And so they built this Clover Assistant app basically on our Health Share and our Iris for Health environment. So the third area that we choose to be great at is scalability. Of course, we want to enable all of you, whether you're a startup or whether you're huge multinational, to scale your offerings, your products to as large as you need.
Listen to this.
And the best example of this, I think, is our relationship with Epic. We started with Epic when they were a startup, and now Epic is the largest, most important EHR company in the world. And also, even if you look at some of our other products.
So yeah, electronic health reporting systems. Okay. So let's go ahead and we can go ahead and finish this video if you'd like. But my recommendation, there's a lot of great insights, but let's go ahead and debrief, and then we'll go to the technical and also answering some questions on the cash flow and giving you some cool insights. Okay. So let's go ahead and let's talk. Okay. So this company, okay, is helping Clover in their Hong Kong division that take all this data, aggregate it, and they take all this mess, this whole signal. It's a bunch of signals, right? And these individuals are going to basically go ahead and make it useful. And then they go ahead and send that, most likely, the signal to their clinicians. And the clinicians are essentially going to say, oh, this was helpful. This wasn't. Oh, this is crap. This is right. And then it's going to be a negative feedback loop system back to the Hong Kong division, back to these individuals that we spoke to that are creating this clean data set. And it's going to be a positive feedback loop system. And every time you get one cycle of the loop, the machine algorithm learns. It gets smarter. It gets more intuitive. And then it's going to get to a point where they're going to get all this data that they're going to be so ahead of the game, kind of like how Tesla has all the data for the full self-driving, right? Beta, right? They've been taking all this data. If you have a Tesla, every time it drives, it collects all that data through its cameras, right? And then that goes to a central data center hub where Elon Musk has the greatest software engineers in the world. And they go ahead and take this data and they make something meaningful. So then let's say, for example, Ford and all of them that can't really make a buck off of these electric vehicles, they're trying to enter this market. He's literally going on to the next level, which is full self-autonomous driving. Okay. So same thing, what's going on with Clover. They're getting this data, and not only are they a data company, now they're also giving an opportunity for patients to be able to choose where they go. There's a lot of data. Most people don't like to listen to the data. There's a lot of old school farts in these incumbent healthcare programs that, oh, it's my way and that's it. Patients want to choose where they want to go. Patients want to choose, how their doctor looks like. Do their doctor looks like them, right? It's very cultural, right? And they're putting in that cultural aspect, okay? So let's go ahead and answer some questions, and we'll shift back to some technical analysis and some cash flow. So very, very important stuff that we got to talk about. So let's go ahead and quickly, I'm going to kind of run through these comments, and if I find something uh, deemed to be discussed, we'll discuss. Let's see here. Clover service has a rating. Yeah, so this guy here, I saw a video where a woman was explaining that Clover service has a rating of 3 while Cigna is 5. She said that they are going bankruptcy. That was last year. So, the beautiful part about uh so let this is a great example, right? So let's go ahead and practice this. Okay. So first off, my first identification of this question is, where did this person get their data from? They got this data from a woman who's unnamed, who I don't know who this woman is. What are these women's credentials? Has this woman looked at the balance sheet, statement of cash flows, income statement? Has she looked at and calculated some financial ratios? Has she attended the earnings call and analyzed what the company is doing? Does she know that they just hired a CFO that is has a great track record in Wall Street and a great track record of taking a company from negative free cash flow to positive? So, and so it's interesting because I saw a video where a woman. My recommendation for your analysis is to keep it directly tied up with the SEC Security and Exchange Commission's filings. We can access directly from our brain machine, but you can go directly to the SEC and search them manually and go to the data. Well, no one wants to read 300, 400 pages, right? Unfortunately, but that's what you got to do, right? You got to be careful because, that's fake news, right? I don't really see that happen. They have an S1 that they filed a while back in terms of their offering. So if they needed any cash, they would be able to get it. Hey, Al, our CLOV and positive cash flow were expected to be. So that's what they said. My calculations say 2024, but they said 2023. Now, there's different types of profitability. The question is he talking about net income profitability, or is he talking about free cash flow profitability? Now, normally there's 3 financial statements. There's the balance sheet, income statement, and statement of cash flows. Now, the income statement shows you kind of the top line, essentially minus all the way down from the operational expenses, and it gives you the bottom line, right? The problem is the bottom line sometimes doesn't actually give you a lot of detail, which is why you need to go into the statement of cash flows, which is separated within 3. Cash from investing, cash from operating, and cash from financing. And within the cash from operating, you can subtract out CapEx, which then gives you free cash flow. Now, if you didn't know anything that I was basically saying, we do teach this at the Mastering Stock Market course. Now, what I wanted to basically show you is, let's go ahead and show you the screen here and go to our brain machine, okay? So let's go all the way down here and let's type in cash, a Q for quarterly, download, and let's type in the symbol. And as soon as we get that, brain machine is thinking. We're going to go in and we're going to download this Excel spreadsheet, okay? And this is directly Clover Health's quarterly statements, okay? This is their cash flow specifically. So we're going to go ahead and zoom in on here to make sure we kind of got this. We're going to clean it up a little bit here, make it a little better here. And I am going to, most people can't read large numbers, so we're going to add some commas so people can see. All right. This is directly from our software here, okay? So this is Q4 of 2019 all the way up to 2022 Q1, and this is the statement of cash flows. Again, like I stated, we have cash provided by operating activities. We have cash provided from investing, cash from financing, okay? So usually you want this number to be negative and these two to be positive, right? Because you don't want them to be taking out stock and issuance and all that. But what I wanted to gear towards you really quickly is I wanted you to go in and I want to see something very clear. We calculate the free cash flow for you. This is an important metric. And what's interesting here, if you look at 2020 of Q2, you can see that they were actually free cash flow positive. I'm going to put this in the green, okay? So actually free cash flow positive here. And it's very simple. You just take the operating activities subtracted from the investment properties, plants, and equipments, okay? And we'll be teaching that. And that'll be integrated within our intrinsic value calculation. But it's interesting here. The net income was actually quite positive during this quarter, right? And they were actually approached really well, but then pandemic and a lot of problems. So they did have at least one quarter of free cash flow positive, okay? Now, I was watching them. Again, I didn't start making videos until around here, until the direct contracting lives came online. Okay. Now, what I wanted you to pay attention to is if you take the free cash flow and you multiply it by the current revenue of that quarter, it's interesting because it came around 7.5%. You remember how I do the intrinsic value calculations? I take 5%. Well, this was 7.5%. Now, if you go along this way and you look at Q4 of 2020, you can see that the free cash flow was 56 million. Okay. Right here, which was also positive. And then guess what the revenue multiple, not revenue multiple, but the percentage of the revenue was 17%. Okay. So this is a pretty damn good indication that there's something important to be looking into here. And now this new CFO is going to help clean up the data here and actually help this company function correctly and actually prove to Wall Street that they do have a business model. Okay. So as of right now, they are free cash flow negative. Now, what I'm looking at is I'm looking at the trend here. Is the trend going down? I'll look at the annual too, because these are divided by quarterly. And again, we get this data directly from our brain machine. And the beautiful part is we have over 40 years of financial data. Now, obviously, this is 2019 because Clover wasn't around 40 years ago. It's a new, okay? So there's that. Let me see. I think that that says everything I wanted to say on there. Okay, so let's go ahead and yeah. So there, if you look at their debt, it has been increasing, but in terms of the current the debt to equity ratio, they are actually doing pretty well in that regards. And I think you could we can actually access that here. So this is our brand new updated brain machine. We actually have buttons now, which is really cool. I believe this is under stock fundamental analysis. We can also do backspace, next page. Let's look at the ratios. We could look at the ratios, current rate, the ratios for Clover right now. So if we type in the ratios for Clover, this is the current ratio, the actual ratios for this date. We can see that they're still over 1, and their debt to equity, so the debt ratio is 0.8, but their debt to equity is 4.47. Now, the way this is calculated is different from the actual debt value that they have. In fact, we could honestly, let's do this right now. I think this would be a for all our mastering students, will be a great example. So let's go to BAL. Let's go to we could do Q, and let's do download, and we could do Clove. Okay. So this is the quarterly balance sheet for Clover. Okay. So let's go ahead and do that. So replace. And let's delete this guy here. Don't save. Oops. Let's go ahead and there it is. All right. So the same thing. Let's zoom in. And let's clean it up a little bit here for you guys. Okay. And let's make sure it's currencies to help people out, kind of see how much this money is. So let's go ahead and let's take a look at the total assets. So let's go to the most recent quarter. So here are the total assets. Let's put that in yellow. Okay. Here's total assets, and here's the total liabilities. Okay. Oopsies. So if you divide total current assets, well, there's total current assets and total current liabilities. So if you take this green number and then the total current liabilities. Let's see here. Total current assets here. So if you take this number divided by this number, let's go ahead and do it. This divided by this, we're doing this in real time. We get 1.15, okay, which is exactly what our brain machine gave you, right? Which is how we got the current ratio, okay? Now, what does that mean? You could do these calculations, but if you don't know what they mean, the current ratio basically says, does this company have enough money to pay down their short-term debt obligations within 12 months? The answer is yes. So bankruptcy 12 months, highly unlikely. Okay. Now, what we're gonna be teaching this in the mastering course, obviously in a better format. This is doing this off of the cuff here. Now, what you can do is anywhere that says debt, I'm gonna put in like a pink so you can still see it. So this is a debt. So we're gonna go ahead and put this in. Let's do orange so we can. That's a debt. Long-term debt. That's a debt. Okay. Now, what you can do is then you can take assets divided by specific debt, right? And just so people can see, debt to equity ratio formula, it's total debt, right? Divided by total equity, right? And you can find the total equity right here. So we'll put this, I guess, we'll put it in the same color, right? So we can say equals, open parenthesis, add, this orange plus this orange, divide by this orange. We get 0.22. Now, again, there's other calculations that go into this, but overall, even with this debt, they're still under 0.5, which is good. Warren Buffett tends to look at companies under 0.5. Okay. So that's, we're going to go into specifics over how to calculate all these different things and how to rip up the balance sheet, the income statement, and the statement of cash flows. Now, let me show my face here really quickly. Now, unfortunately, let me take this off. Now, unfortunately, most people, when they buy a stock, they just look at the technical analysis. They draw all these squiggly lines. Now, I understand those squiggly lines. We're going to be teaching technical analysis, the wedge and, 3-bar play and ascending triangle, descending triangle. So, simple moving average, exponential moving average, RSI. But that's easy. I can teach a monkey to do. In fact, our AIs do that, right? But you want to know where you put your money in. You can't just put your money in shit, right? So we're going to be watching this company very clearly. I am starting to see some, not red flags, but flags, which will, keep you guys updated. But it's, I would say it's a normal process. If you look at, just very quickly, if you look at the total current liabilities, we do see an increase, a big jump in total current liabilities, but we did also see a current jump in total current assets, right? So there's a couple things that we need to pay attention to, but from what it looks of it, they said that they're going to stop expanding for right now, and they're going to focus on what they have so they can make it like the New Jersey market. All right, let's go back to our room here, and let's look up more questions. So I need to take a look a little bit more deeper with GameStop. I haven't really taken a look at it. I've been so busy building our, as you can see, our artificial intelligence platform is becoming very strong. You can see it's really cool. I've been building this for our members and also our lifetime members at the Mastering Stock Market. But it's really cool. You can go to Stock Fundamentals now. You can hit the next page and go back to the menu, and you only see this, right? You could do price targets. Like, for example, we can look at, let's say, what are the price targets for GME, right? Like what analysts say. And you can see that, it'll cut you the price targets 23 here from this guy, Brian, from Oppenheimer. We got this guy $100 from, Jeffries, right? You can also go ahead and do an advanced leverage DCF of GME, which should give you the price target. Oh, so this is a tester account. So you can only do 10 every month. So it says you don't have any uses left. But what it does is it gives them if you have lifetime access, it'll give it to you. Or if you're part of our Al Stock Alerts, it gives you 10. So you probably already guys gotten this message. So I need to go ahead and give myself here. Let me. Oh, 1 minute. 1 moment. Let me manually change this. Let me manually. There it is. Okay, so now we can do it. So Al DCF. Let's look at GME. There it is. Okay, so we can see here the equity value for GME is around $35. That's how much it should be worth, right? But again, I would always follow it up with the Mastering Stock Market course, Intrinsic Value. We also have the advanced DCF. So we can do GME here. See what we get. So $52 here. Okay. Now they're about to split too, so that's something else. Also, price prediction for Clover is only off of the revenue projection without SaaS. That's a bonus. Yeah, exactly. So once you get into the SaaS, it starts to get into a level of 15, 17%. But I like to undervalue it because we are projecting a negative free cash flow company. That's the only way to find a bargain because the market's still overvalued. Now, there's some stocks like Alibaba that are like really free cash flow positive. But, there's some risks with China. Oh, I wish China can be our friend, I mean, very nice people, I kind of wish, in somewhat, right. There's still a lot of, problems that are happening with human rights, but, PayPal's a good one, so there's a lot of great things but there's a lot of stocks like Microsoft, Apple, I would call them still, overvalued. Now, I do want to mention something really cool here. So if you go to our proprietary software here to our intrinsic value, okay, we updated the Mastering Stock Market students. We now give them a recession level. So now they have a recession output. So now you guys get recession prices, which is pretty cool because let me go to announcements. If we go to here, I announced that there's a lot of things that we've done with so much that look at all the innovation we've done. Here's a good one. Here's Target. If you look up Target, here's the price projections for Target, and you can see the recession level is $86. And if you actually go to Target stock, we actually have the highest of 277 based off of our calculations. And if you go to the highest, it was 268. So you can see it's right near it. But if you go to the recession of 2020, you can see it hit right around that low 90s region, that recession level region, which is right around what we have here. So it's really great. But these are for more of a large caps. You can adjust the discount rates, which we'll be teaching. Okay, let's go ahead and take a look at it. And we're going to go in and take a look at some stock research for Clover. We see some of our students today putting in some information for Clover. So, I mean, I'm not too sure what the point the woman had. If you look at the current ratio, if you don't know what that means, I recommend educating and learning what the current ratio is. They do have enough money for 12 months. And then they said that they're going to be able to be free cash flow positive and self-generating from that region. And if they don't, they still have filed for share dilution if need be. Yeah, that's the thing. It's definitely too early for sure, but the market is. Uh, it has been strategically demolishing small PE companies. Let me explain if I can have the. Let me explain here so I can kind of show you. So let me open this up and. Okay, so now you're here. Let me show you this. So as you can see, let me minimize this. As you can see, guys, here are large caps and here are small caps. So you can say a Clover's a small cap, right? You can see that small caps have been deliberately punished at levels, at recession levels. In fact, we're at 2000 almost 8 levels, right? So you can see the market has really hurt a lot of small caps. So this is obviously not a this is an overcorrection for the market. But if you look at 2008, mid caps have still a way to go. And if you look at 2000 here, large caps are still definitely, you can see they still have some ways to go. Okay. So just kind of keep in mind of how that works. Okay. So let's go here. All right. So now let's go ahead and take a look at the support and resistance. So we're just going to go ahead and we have, again, all this from our Al stock alerts, which is pretty cool. So let's look at the minute. Let's do the day. Let's do the week. And let's do the hour. I didn't do the hour, so we'll do that. Okay, so based off of this, we definitely been breaking that $2.50 resistance. We just literally kapowed right through it. And again, if you had our program, you would have been able to see this beautiful level of support here, and it bounced off, and you could have been trading these bounces. And if you want more advanced charting, you could go here and go specifically to the specific chart and take a look at I would say here, type in CLOV with the minute. You could trade off of these with the SMAs and do CLOV with the hour. Use this to help you because this also pre-plants the resistance lines as well. These are advanced charting mechanisms. You could do the week and also the day here too. So you can get a little bit more data here, and you can see how it's been helpful having these lines to assist you in your trading endeavors. Now, personally, I like these ones, so you can really see those resistance and support lines. Let's go in and take a look at the hour. So you can see right now the next level here is $2.70. That's the one that we need to break, right? And then after that, 307, 365. And then we got that 419, 747, like I always said, 1204, 1503. Okay. So there's a lot of resources that we offer. This is the Monte Carlo simulation. It gives you the price projections of what the machine thinks 30 days, as you can see from the x-axis here. So it thinks it's going to go down. All right. So there it is. So that's pretty much all I have. I do want to basically talk about this. So if you compare our stock alerts, which is our monthly plan, which is only $11.99 a month, if you compare this plan to Morningstar, compare what we give you in comparison to what Morningstar gives you at literally more than double the price, or what Yahoo Finance gives you, we blow them out of the charts. We were able to hire a software engineer and a whole team to be able to basically build this. And me going literally, we're working 24/7. We have a team literally from the other side of the planet. When nighttime falls in the US, my team in Europe wakes up And we're literally 24/7 working on this, which is why we're able to do so much with our platform. So we are building something that is amazing. Retail is this is amazing. I'm very proud of what we're building here, and there's a lot to it. And we do have testimonials too. So if you guys are interested, we have this as well as our lifetime plan. So that's all I have for you guys. It was a privilege and honor, and yeah. So I'll see you guys in the next one.